Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Thick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's Pre-Market Prep. Special edition today. Spencer Israel here. No Joel or Dennis. They are both in Cleveland for some reason. I'm not really sure why they'd go there, but they live in Detroit. But we're joined today by Brent Slava. He is the head of Benzinga's news desk. I'll bring him on screen there in a second. But Brent and I are gonna. It's gonna be a little bit of a different show. Whereas normally Joel and Dennis will give their thought process and their logic as far as trading goes. We're going to try to give the thought process behind movers as far as information and news goes, and sort of trying to digest, what headlines or what movers mean for news and vice versa. So we'll get to Brent in a second. Let's cover some futures here. The overnight markets, S&Ps are up. Last I checked, about 1%. Gold down a stick. Joel always talks about that double bottom. Gold and crude futures both hit double bottoms, pretty much the exact same price last night. So he always talks about those. I'm throwing my hat tip out to Joel on that. Bitcoin, last I checked, up about 0.5%. All right, Brent, I almost said Joel there. Brent, I'm going to bring you on the screen. And Brent, welcome to Pre-Market Prep.
Hey, everyone. Thanks for having me, Spence. Thanks for being willing to listen to me, listeners out there.
Yeah.
I guess they don't really have a choice.
No.
Do they?
Well, they could not listen if they
don't do that. Don't do that, ladies and gentlemen.
All right. So we'll cover some earnings that are just off the top, and then I want to move into some movers from yesterday. And kind of our thought process on how we attack that as a news desk.
Yeah.
So the first thing I want to look at real quick is Herbalife. Herbalife reporting yesterday, Q4 adjusted EPS $1.29 versus a 96-cent estimate. Sales of 1.1 versus 1.08 billion dollars. So that's a beat on the top and a beat on the bottom for Herbalife. Their Q1 guidance coming in light on the Q1 guidance. $1.30 was the estimate. 90 cents, $2.10 is what they said. Fiscal year EPS coming in very light as well. So they missed on the EPS estimates for the fiscal year. Brent, do you want to give us some technicals on that?
Yeah, sure. And I would definitely say we're trading down about 4% right now here. We're flirting with $80. It's definitely that guidance. And really with any company, when any company reports, it's going to be the guidance, and we see that here this morning with Herbalife. As I said, $80 is where we're kind of flirting with right now. Note that the after hours low was $76 on the button, 76.00. When I see, at least for me, I'm sure Joel would view it a little bit differently, but when I see big round numbers in play, it leads me to believe that there are maybe more technicians in it, or maybe technicians are dominating the trade. So when we have a pre-market and after hours low of 76 exactly, and we have a stock that's trading at $80 right now, that is leading me to believe that there is just going to be a ton of technicians that are messing with this one today.
All right. Next one, I want to move on to the pair of HP stocks. So we'll start with HPQ. Reporting adjusted EPS of 48 cents versus a 42-cent estimate, and sales of 14.5 versus $13.49 billion. So they beat on the Q1 numbers. On the top and bottom did HPQ. Guidance-wise, Q2 EPS coming in higher, but only slightly. Fiscal year EPS coming in higher as well. So good, kind of the opposite of Herbalife there, with the good fiscal year and Q2 EPS guidance for HPQ.
And jumping over the chart right now, I'm going to do my best impersonation of Joel here. And
a good one.
Well, not like that comedian did the other day. Just like I'm going to channel my inner Joel here. And I'm going to zoom my chart back out. I pretty much always look at minute charts. When you're dealing with news, I need to be able to look over at my chart and see if a news item impacted a stock right away. So I'm always looking at 1 minute charts. Joel, I know, is a fan of the daily chart. So I'm going to use my daily chart here for HPQ. And using my daily chart, it looks like there was, at least on the downside for a support level, there was a few touches around 2050 or 2060. So that is a level to watch out for on the downside. On the upside, if you're looking for where there might be a little bit of resistance in HPQ, I would pick a nice round number like $22. We're trading at around 21.39 right now.
Moving on to the other HP stock, HPE. Of course, yeah, that's split there. Q1 EPS 34 cents versus 22 cents. That's a beat. Sales 7.7 versus $7.07 billion. So beats all around on the Q1 numbers. Q2 numbers got EPS guidance coming in higher. Fiscal year EPS coming in higher as well. So kind of the same situation or opposite situation here for HPE as HPQ.
HPE trading up about 12% right now. Strong move higher. I would look out for $17 on the upside. And let's just make it easy on the listeners. Let's call it 16 on the downside here this morning. What was I going to say? The thing that I was going to say, when you get a strong reaction out of a company like HP, look to a tech ETF. Like let's look at the XLK. And this thing is going to be feeling impact here this morning because of a strong report out of a company like HPE.
Brent, you're really good at finding sympathy moves.
Yeah.
How do you do that? Like in identifying stocks that will trade together, or knowing stocks that are related.
Yeah. Okay. So I have a good, I would call it a good resource. It's very simple, but I like to use, there's a very simple feature on Google Finance. If you type in any ticker on Google Finance, you're going to see the chart. You're going to see our little statistics. If you keep scrolling down, Google Finance does a nice job of showing you related companies. And whatever algorithm puts those companies that are related together, it does a pretty good job. And if you even want to like zoom in a little bit more on Google Finance, they'll break it into the sector and the industry. And so like I went on Google Finance, I typed in HPE and it's showing me the sector, right? Or excuse me, the industry is computer hardware. You can like click on where it says computer hardware. You can click on that industry and it'll show you all the companies in all the companies in that group. And I'll just do pretty much some manual work. I'll click through a few of them and see if they're moving. You want to look to see if a news item impacted a stock as close to each other as possible. So like if I'm wondering if HPQ is moving off of HPE, I could look on my chart and see when the news item happened and see if they both moved, if they both responded at the same time. That's kind of like how I'm doing it.
All right.
Good questions.
Last earnings stock I want to cover for now. And then
Sure.
I want to move on to some other movers. We have about 8 minutes or so, 7 minutes into our first guest of the day, Ryan Craver. I want to move on though to Intuit.
Sure.
Intuit reported yesterday after the bell. Q2 EPS 35 cents, that beat by a penny. Sales of 1.16 versus, well, that was the estimate. So inline sales and a beat by a penny on the EPS. The Q3 sales guidance came in higher. The EPS guidance came in line. The fiscal year guidance came in line for both sales and the EPS So a lot of inline guidance there and a slight beat on the Q2 numbers there for Intuit. Anything you're seeing that jumps out to you on the INTU chart?
Well, yeah, the 52-week high was set yesterday. So, I mean, that's fine if investors want to bid up a stock to a 52-week high ahead of an earnings report. That earnings report better blow it out of the water.
Dennis always says that. It rides up until the report.
And if that's not going to happen, it appears to be the case here with Intuit this morning, then that thing's going to sell off. And we're down about 4% here right now into it. 172.10 last tick. The high from yesterday was 177.51.
I want to move on now to some of that we actually haven't discussed on the show for the last couple of days, but it's been sort of in the news, and that's Domino's. I want to bring up this chart of DPZ. Brent, I actually missed this headline. It was from a couple of days ago.
Yep.
Can you sort of like walk us through what happened with Domino's the past couple of days?
Yeah, and just to reiterate, we're giving you some views on sort of like more of a news perspective. I'm more of a news guy. Dennis and Joel are more traders, obviously. So you're not going to get sort of the same like trading aspect, but want to give you a little bit of insight into like what happens with some of these news items that you guys and gals might hear about. So what happened was the market was closed on Monday, but on Monday there was a report out of a publication called the Brazil Journal. And the Brazil Journal report was sort of speculating that QSR, like the parent company of Burger King, could be interested in Domino's Pizza. So this report was out on Monday. The stock Domino's, if we pull up the chart on Tuesday, it like spiked off of the open, but it didn't really move. And what happened on Wednesday was there was a source on Twitter, probably doesn't really matter necessarily who the source was. We just know that the source got traction. The source on Twitter retweeted, he tweeted, he or she, it looked like it was a he, but you know, we can't know for sure. He tweeted out the Brazil Journal story and added some language to his own tweet that said, hey, heads up, here's this Brazil Journal story. Sources are telling me this deal is going to happen. It appeared Domino's shares started responding following that tweet, and that was late on Wednesday. That was about, let's see, 2:40 p.m. Eastern time on Wednesday. Shares of Domino's were trading down for the session. They were trading around 223.40, let's call it. They spiked all the way to over 230. So spiked about $7 on that.
And that's right here that I'm circling on this chart here. Keep going.
Okay, great. So we're watching this happen. We're like, okay, let's definitely immediately get a hold of Domino's and let's start considering who this source might be. So we're watching the Twitter account, and what do you know? The tweet that seemed to have initially got shares of Domino's moving was gone, suddenly deleted. Minutes later, the tweet came back. The guy or gal, the Twitter account, put another post up. It was almost the exact same tweet, except removed the language that said sources are telling me this deal is going to be likely. That was gone. Now let's look at the chart. The stock has not given back all of these gains yet. So again, the stock spiked, $7-8 on this report. The report was more or less, what's the word I want to make? What's the word I want to use here? The report was more or less.
We're skeptical of it.
We're definitely skeptical of it. There was some glaring oddities in what was happening with this, but the market, doesn't necessarily care here. The stock is still trading up about $4 or $5 from where that was happening. So, is there more to this report? Is there stuff that people know about in the marketplace that isn't public yet? I mean, of course, but it just seems pretty odd that the source would, make a big commotion on Domino's and then kind of like rescind what was said.
But the timing seems odd too. On a day that the market is closed.
Absolutely. No question. There's like a lot of weird sort of aspects of this one. Nonetheless, what is happening right now, as I said, Domino's is still trading up about $4 or $5 seemingly on that report.
Seemingly on nothing.
On
nothing
exactly.
Is kind of what we're saying there. So that's one, I guess, to keep on your radar for the next, I guess, for today, and kind of see.
I've been watching it.
You've been watching it?
I've definitely been like anxious to see what's been going on. You know what? I totally forgetting. There was an important part here that I'm forgetting. So there was a firm out yesterday. And you're going, what the heck is this firm? Well, this is a Brazilian firm. There's a Brazilian firm out there called, South American. I'm not sure if they're Brazilian. BTG Pactual. It's like a sell-side firm in South America. The firm put out a comment that said, there's no deal between Restaurant Brands and Domino's Pizza. The rumor from Brazil Journal is false. And the firm was pointing out that the publication's past has been, quote, spotty at best. And even when that headline came out, we heard about that headline yesterday at about 11 a.m. And if you pull up the chart, you already got the chart there. You can see that the stock did move lower on that. It moved lower almost to about the 224 level, but we're trading at about 227. So, take it for what you will. Take it for the way that I think I'm sort of hitting at it, or you can take it for the way that, we had some concerning comments about this report and investors didn't care. They still are buying the stock.
So either way, I think the takeaway here is Keep an eye on stocks that move up on skeptical news, because we don't know what's really happening. We're
trying to give you what's happening in real time, but a lot of times we're also like discovering this stuff in real time. So, in your Benzinga Pro terminal where you're getting that breaking news, you'll see, a lot of times you'll see sort of that live process playing out in the headlines where we're sort of like discovering things. It's something that I think if you're a Benzinga Pro user, I think that's something you can definitely use as a tip as you're looking at some of the headlines.
All right, we need to talk about the theme of next week, which will be retail earnings. And to do that, we're going to bring on our first guest of the day, Ryan Craver. He's our go-to retail expert, the Senior Vice President of Emerging Brands at Lamour Group. We'll be right back with Ryan in a moment. Welcome back, everyone. This is PreMarket Prep. I'm Spencer Israel, joined by Brent Slava, guest hosting today. And we are on now with Ryan Craver. He's our go-to retail guru. Ryan, how's it going today?
Fantastic. Happy Friday, everybody.
Happy Friday, indeed. Ryan, it's been a while since we had you on, and something that I've been asking all of our guests who we haven't spoken to in February is how did you handle the early month kind of slap in the face that the market got? It's been a while since we've seen that.
Yeah, I think what ended up happening was we saw a relatively strong December holiday season. Everyone was quite excited rolling into January. We even got some macro numbers that were above expectations. We saw a positive number from department stores, and then it kind of just teetered out, and everyone's kind of starting to get back to where they were and thinking that retail is dying, specifically with the news we got from Walmart and having their e-commerce number being so low relative to previous quarters. So I think everyone's getting bottled up and ready for next week, because we do have some big retailers to announce next week. I think largely the story hasn't changed in terms of who's doing well and who's not doing well. We saw Home Depot's numbers. That home improvement sector continues to do very, very well. But we're going to find out a lot of how well we truly did next week.
All right, so let's talk about that Walmart quarter. The only thing that really matters is the e-commerce sales then, because that's what the street's taking this to mean.
I think the entire narrative for Walmart changed with this latest earnings release. Everyone had been thinking that they had figured out their future with e-commerce, but we specifically spoke about this a number of months ago. They bought their way into growth in e-commerce. They bought Jet.com, they bought Bonobos, they bought ModCloth. And yeah, that paid off for 4 quarters. Then what they did was they tripled the number of products they were selling online. And they raised prices going into the holiday season. And I think they raised them a little too much and realized that they can't do as well as they thought they could. So what we've seen is they've now lowered quite a bit of prices across the site to try and boost that back up. I think what I read into the numbers is a 23% growth rate is well below their guidance of 40% for the year. So they're going to have to buy that back. They no longer have the option of tripling their SKUs online or the number of products they have online. My belief is they're going to have to go big, and it's going to have to be 3 to 4 times the size of Jet. And I think the one that sticks out to me, the one that has dropped, as recent as yesterday, is Wayfair. I think Wayfair is the type of company that they'd be looking for to boost their e-commerce story. This is right up Lamour's street and something that I think that he would want to buy. And that's where my head is on Walmart.
So you're saying Wayfair, which I was going to get to next, a potential takeout candidate for Walmart.
Yeah, that's who I think they would go after. I mean, the size of the company, the growth rate with which they're going through probably brings back the narrative for Walmart to say, look, Wall Street, we have a growth trajectory within e-commerce, which is the hot thing. We continue to have our stores that are seeing positive comps as well, albeit 1 to 2%. But we've now got that growth in e-commerce again.
Well, let's talk about that Wayfair report quickly. So they also got cracked yesterday on their report. What did you take away from that? We've got, maybe the biggest or most well-known short seller on the street, Andrew Leff, saying they're running a terminal business model. But what did you take away from Wayfair's report?
I've never really been a big fan of Wayfair just because I've never seen a path to profitability. Wayfair is one that overspends on marketing to drive traffic to its site, to drive a final sale. With that said, a lot of people love these stratospheric growth rates that we're seeing from some of these e-com players. I just think that they are driving a growth rate to get to an acquisition by a big company, and whether it's the Amazon, Walmart duel that will take them out, that's my biggest bet, or some other major home improvement and or furnishings retailer that needs a growth rate or needs that particular customer who is a more value-based customer. One of my other thoughts about a year ago was maybe this was a restoration hardware type play, but it looks like they are doubling down on stores. But Wayfair, I'm just not a big fan of because I just don't see any road to profitability unless they dramatically cut their marketing expense.
My co-host Brent pointing out in our chat that Wayfair has been considered as a target for Walmart in the past, actually last May. Someone else in the chat asking about Shopify as a potential takeout candidate for Walmart. Do you have thoughts on Shop?
Yeah, so it's actually a very interesting thought. I think the interesting part about Shopify to me is that what they've got is the small and medium-sized businesses. I'm a huge fan. I'm a holder for a long time. And basically, if I'm a small and medium-sized business and I want to open up a website, Shopify is usually the choice for me. It's got integration with a number of shipping providers. It's got integration with Amazon and many others. With that said, I think Walmart would love to have them. And I think it'd be great for the Walmart story. I just don't think they would sell out to Walmart. For whatever reason, yes, anyone can be bought. I think they are more of a platform, and I don't think they view themselves folding into a retailer. They're quite a bit bigger than Wayfair, but I think, Walmart ultimately will buy who is in the business, not of software, but in the business of selling product.
I want to move on, Ryan, to next week's reports, pretty much the week of retail. And you mentioned it off the top. We've kind of seen the story shift from the end of the year. We've kind of given back a lot of, retail was on the comeback all of a sudden until it wasn't. And so for you, is next week going to be more of a a macro story? Or are you going to look at individual names, or will they all kind of be driven by the same sentiment? I think we lost Ryan there, actually. I'm going to get him back right now. Sorry about that, folks. I was wondering why he wasn't answering my question. I thought I stumped him. For a second.
He was thinking real hard.
He was
sure how I lost you.
That's okay. So I was asking, my question was, is next week more of a macro retail story, or is every company going to be driven by the same sentiment, or do you see it being more of an individual story?
Well, so I think the department stores, for whatever reason, them being small relative to the overall retail industry, they drive a lot of the narrative for the retail sector. And we've got guys like Kohl's and Nordstrom next week. We've also got some of the off-price guys coming up the following week. And we've got Costco on 3/7. So I think next week is going to start here's where department stores are. Here's where e-commerce needs to become a big part of the story, and they'll probably drive the XRT, even though they don't make up the majority of the industry.
Any particular companies that you're feeling good about?
Yeah, so I still believe in Costco is the one with the strongest moat against Amazon. Obviously, they have the large membership base. I think they've started to talk a lot more about delivery and what they plan to do with e-commerce with guys like Instacart. I'm a very big fan of one particular off-price player in general, which would be a Burlington, who I believe is the most prudent and pragmatic of the group of off-price retailers. I think TJ Maxx is going to post something that's either flat or slightly positive, like they did the previous quarter. Ross, I think, may be one that's relatively okay, but I like Burlington within that sector. Kohl's may surprise us a bit because a majority of their locations are outside of malls. Malls are where the major weakness has been. So they may do okay. I'm not too optimistic about JW Nordstrom. However, we did see the macro numbers be a little high, so they may do okay. And then other than domestic, I'm still a huge fan of Amazon. I think that negative news on the Walmart earnings release will definitely play to the benefit of Amazon, and it's going to make another historic high, even though it's at $14.85 or whatever it's at today.
I joined Costco last quarter, so if the numbers are high, you could have me to thank for that one. And then my last question here, Ryan, and then I'll let you run. Yesterday I brought up on the show, we were talking about Cheesecake Factory earnings, and I brought up a note that has kind of stuck with me, a note from Credit Suisse that has stuck with me for the past couple of years now. And the analyst kind of noted that he looks at Cheesecake as as an indicator for Nordstrom's. Have you ever heard of that or observed that yourself?
I have not. Do tell me more. What's the thinking there?
The logic is that according to this one Credit Suisse analyst, that there's Cheesecake Factories are always next to or outside Nordstrom's. They're both in malls, and granted, there's lots of department stores in malls, but he singled out Nordstrom's specifically. Just because they always, according to him, are in close proximity to each other, either across the way or next door, and so the sales of Cheesecake, which typically reports before the retailers do, the sales of Cheesecake can inform the sales of Nordstrom. So maybe look into that, Ryan.
Yeah, that's very interesting. I think it may be slowly diverging though, because keep in mind, Nordstrom Rack now is kind of the growth driver and the largest store count for Nordstrom. But that's a very interesting thought.
All right. Ryan Craver is our resident retail guru. He's the Senior Vice President of Emerging Brands and Digital at the Lamour Group. Ryan, thanks so much for the time. Thanks for previewing the sector for us, and have a good weekend.
Awesome. You too, guys.
Right.
Thank you.
8:29 now. Brent, I want to bring you back in here for a second. Anything specific you've been watching this morning, or you were watching in those last 15 minutes as far as movers go?
Not especially. There is a company that we didn't mention, Xera. It's ticker XCRA. It is very volatile right now. Stock is trading. Trying to pull up my chart real quick.
Oh,
do you see any price action? I mean, there's price action. I don't see that it's moving around a ton. This company announced last night they had some earnings, but they also announced that they were going to withdraw an application from the CFIUS and terminate a merger deal with a Chinese investment company. And we're just getting some kind of swings in this stock right now. I heard that there was at least a couple traders who were interested in kind of taking advantage of some of this volatility in the pre-market this morning.
All right, I want to move on to another stock that wasn't super volatile yesterday, relatively speaking, to the past couple months, but an interesting story nonetheless, and that's HMNY, Helios and Matheson. We talk about,
Sure.
of course, on this show. I want to point out specifically the price action from so this is a 1 minute chart here. The price action from like the latter half of the day. So
Yeah.
from this jump up on here, that jump at around starting at 12:30.
12. Let's call it even like 12:45.
Okay. All right, and the reason I bring this up is because with stocks like this, and when I say stocks like this, I mean stocks that have made large moves and have now come way off those moves.
Yeah.
Either way off those highs or way off those lows, and you know that there's people trapped on the long side or short side, very, very prone to manipulation, and we kind of saw that firsthand yesterday.
Yeah, a little bit.
A little bit.
At least we can probably tell listeners a story right now, and you can maybe walk away with a little bit of your own thoughts, whether you think this is a bullish signal or bearish signal or neutral or whatever. I think you might get a little bit of insight. So the thing that I would sort of disclaim on this is that this thing is heavily technical right now. I would say if we're looking
look at that chart,
right? If you were looking at a minute chart, again, sort of calling back to something I said earlier, when you see technical things happening, like when you see a stock hit a round number like 470 in Helios and Matheson, and then move away from it, and then try it again, and then move away from it, and then try it again, you know that there's technicians in there. You know that technicians may be dominating the trade. So, what happened around 1240, let's call it 1245, was the stock was bumping up against the 480 level. At the same time, we heard that there was a source pitching an interview that they did with the CEO of the company, Ted Farnsworth. There was a source that reached out to Benzing and said, hey, I have this, awesome interview. That's what he said. And this great interview. Want to see if we can publish it on your site. And we kind of read through the interview, Spence, and we were like, well, I don't know. It's not that great.
We publish articles from contributors, frequently, all the time.
Yeah.
But we always look through them.
You need something. We're not just
they got to be good. We're not.
We're not. So we kind of look through the interview and we're like, yeah, there's not really a ton of stuff in there.
Also, it was blatantly very friendly. We'll say that it was a very.
There was a disclosure at the top that said the source was bullish. The interviewer was bullish.
Right.
The person that emailed, who appeared to be the interviewer, also said that they contacted Seeking Alpha, and Seeking Alpha wasn't going to publish it. So we're like,
so it's all for us if we want it.
If we want it. And so I don't know. Red flags are sort of going off for us. This is all while we're watching the stock move higher on sort of an apparently technical thing. Maybe it's related to this touting of this article that's happening. But kind of like, going back to what you were saying, Spencer, when you have these momentous names, when you have like your Helios and Matheson, or, your Snap, or even like your Riot blockchain, when you have these momentous names, they're amazing vehicles for volatility. They're amazing vehicles for a trader to potentially win some up and down price action. But just be aware that you are definitely going to get some noise in, like, you're going to get your Pollyanna bull jumping in and being extremely excited about it. Same thing with the Bears. Just a little bit of warning here.
Right. And then, so that story, long story short, before we go to our next guest, that story ended up being published on Seeking Alpha. And as soon as that happened, we got blown up.
We got like 5 or 6 emails saying, "Oh, look at this exciting interview with the
heads up on this interview that just went live."
And in on the news desk, we try to use those as like signals. You know, we try to use those as indicators for the sentiment out there, and it wasn't like, I guess, the most reassuring.
No, take that away from that. Wasn't the most reassuring thing. All right, 8:35 now. Let's go to our second guest of the day, Phil Davis, founder of Phil Stock World. We'll be right back in a moment with Phil. Welcome back, everyone. This is PreMarket Prep. Spencer Israel joined by Brent Slava today, guest hosting, and we are joined now by Phil Davis. Phil Stock World is his site. Phil, how's it going today?
Great, Spencer. How you doing?
Doing well. Phil, I think we last had you on, I want to say, like, first week of January.
It was the 8th. I know that. I just checked.
Okay, it was the 8th. So you're very active, across all sectors of the market. Walk us through the first week of February for us at your trading desk and what you guys were doing.
All right. But first, I have a question. I want to know if I get the prize so far?
The prize for
the best trade of the year.
What was it? You got to give it to me. What was the trade?
When I was on your show January 8th, Bitcoin was $17,000, and I told people we sold all our Bitcoin and we bought green coin.
You did you didn't mention that you had 4 Bitcoins, you sold 2 of them, you sold 2 of them, and you had converted those to green coin. Where's green coin at right now, Phil? I don't know.
Green coin has gone up 4 times since we talked. It's now it's still 4/100ths of a cent though. It's around what Bitcoin was when people used it to buy a pizza.
Okay. All right. Well,
so it's still really, really cheap. But it went up from 0.001 to 0.004. So that $17,000 went up to $68,000 in a month.
All right. Well, I guess we'll keep it. Call me when it gets to $1, I guess. But
if it goes to $1, that'll be $1.7 million. All
right.
I'm sorry. No. I'm sorry. That'll be. Yeah, that's right. No, $1.7 million. Yeah. So if you want to wait, yeah, okay.
Okay. Walk us through.
Then I definitely get the prize.
Okay. Yes, you get my green coin prize. Walk us through that first week of February for us. We finally have some volatility. How are you kind of looking at things that week? Because remember, Phil.
What do you mean, the first week of February?
Right. Remember, last time you were on the show, you were saying, you look for stocks fundamentally that have value. It's impossible to find anything that has.
Okay, yeah. Well, we jumped all over things. I mean, that was that. As I told you last time, we have a watch list.
Right.
So we keep a watch list for our members, and we've got like 50 stocks on the watch list, and those are stocks we'd like to buy if they get cheaper. And last time we talked about some stocks that were on our watch list. I think we talked about GE and Apple and Barrick Gold, Bed Bath & Beyond, Hanes brand, Macy's, Limited brands. I think those were, I'm pretty sure those were the ones we talked about. So all of them got cheaper in the dip, and all of them, except for Hanes, except for the retailers, we added all of them to our portfolio while it was dropping. I mean, we that's what we do. We're kind of, it's like Warren Buffett style of investing. Like when people are panicking, we're running in with the cash.
So how did you know when to buy during that sell-off?
Oh, well, we're very much fundamentalist, and being a market fundamentalist, it's not just about about looking at each stock and determining its value, though of course we do that. But then we'll analyze the top 100 stocks of the S&P and determine their fair value. And we'll analyze all 30 stocks on the Dow and determine their fair value. And from that, I don't want to say no, but we have a pretty good idea of where a sell-off is going to take us to. So, we expected a 10% sell-off. That's exactly hit our target on the nose when the market sold off 10%. And that is what we expected for the first down leg.
The market,
and we're still actually expecting a further down leg. But we think where we are now, which is S&P like 2,700, we think that's going to actually be the top for the rest of the year, not the bottom. We don't expect to bounce from here. We expect to start consolidating lower for into the summer anyway, and then hopefully at the end of the year we can bounce back a bit.
Why do you say that?
Because stocks are still overvalued. I mean, the big mistake that traders make, and most traders are technical traders. 90% only technical traders these days, which is very sad. But most traders, they look at a chart that was at, like S&P was at what, like 2850 or something like that. So they look at the S&P at 2850 and they go, oh, well, we fell to 2700. Now we're going to bounce back to 2850. They don't take into account the fact that we never should have been at 2850. That was never the right price. It was a ridiculously overbought price where the PE ratio of the index was completely unsustainable. And then earnings, of course, in the first quarter disappointed. And as those earnings started coming in disappointing, and I don't mean disappointing like they weren't negative, but they weren't so positive that they justified a 20% bump in the S&P. Maybe they justify a 10% bump in the S&P, and that's why we dropped 10%. There's still a lot of optimism out there. But we still may have another 10% to go before we're at the right price for the S&P.
When you say you look at the top 100 in the S&P and you determine their fair value, how are you doing that? What metrics do you use to look at fair value or define fair value?
Well, we look at the debt load, we look at their cash flow, we look at obviously the business prospects of each company and decide like whether they're growing or shrinking and how fast they're growing and so on and so forth. I'm an old time M&A consultant, so I mean I look at the companies if I'm going to buy it. I'm really digging into these things. So every company I look at it as if I'm buying the whole thing, not just I'm buying a share of the company. And I basically say, would I pay $6 billion for this one? Would I pay $100 billion for that one? If I have $100 billion, is that where I'm going to deploy my capital? And, so we look at them really deeply into what they're doing. We look at their balance sheets. We look at what their debt load is. And you can't just look at the debt. You have to look at what the interest is on the debt. Just the fact that, people do that all the time. They look at like whether a company has debt or not, but that has nothing to do with their position. Some companies can carry debt, like Frontier, for example, FTR, a massively beaten down phone company because they went into debt to buy to invest in their infrastructure and to buy customers. That's what phone companies do. And they got treated like they were going bankrupt. It's like they made a decision to take on debt when debt was cheap to pick up business while the business was cheap. It made perfect sense, but people treated the thing like it was poison. So, we grabbed a bunch of that too.
So just to be clear, you hopped into the GE and a few of the stocks you mentioned last time, Barrick Gold, you hopped into those during the sell-off.
Yeah.
Okay, so you hopped into that, even though you still think we're heading into a period of broader consolidation.
Oh, sure, but yeah. Well, I will say there's practically nothing in that. I'm sorry, not practically. There is nothing in our portfolio that we wouldn't be thrilled to double down on if it dropped 20%. We would not at all be surprised. And not only that, though, but we also hedge our portfolios. So we make quite a bit of money. In fact, our most profitable portfolio at the moment is our short-term portfolio, which is our hedges. And our hedges are up 22%, and our long-term positions are up 8% for the year so far.
How are you hedging?
So our hedges are doing better than our longs.
How are you hedging? Are you using just options or
mostly indexes? We tend to use we like to use bullish spreads on the indexes, and we've got SQQQ. We use TZA. Hang on, let me take a look. I'll tell you exactly. Oh, we were using, what did we get rid of? The banking one, FAZ. FAZ we were using. Now, we cashed things in though. See, what happened is when the market dropped 10% and hit our level, we cashed out the long leg that we had. We cashed out the profitable hedge that we had, and we had buffered them by selling short calls against them. We let those ride, and then when the market bounced back, we bought those back. So it gave us a huge profit running it that way. But that, again, that goes back to you have to know what the fundamental channel you're in is. And in fact, frankly, if you look at our site today, we have the chart that we've been using all month to show, it basically shows you where the S&P is going to go. And it's based on the calculations that we make as to the value and where the resistance points are going to be as far as where different people are going to start stepping in and buying it.
So those
I'm selling it, by the way, we're short right now because 27.28 is the top.
Wait, you're net short right now?
Right now we're short because 27.28 is what we call the strong bounce line. So off the 26.40 line, which we think is the base at the moment, 27.28 was the strong bounce, and that's where we keep shorting it this week.
So those ETFs that you used to hedge, I believe most of them ones you mentioned, the 2 or 3, those are leveraged ETFs. Would you ever trade any volatility ETFs at all, or is that not your bag?
Oh, why do you say that? I'm trying to forget.
I'm sorry.
I'm sorry. You're sorry. We shorted No, we didn't short. I'm sorry. We sold a short put on SDXY. Now, we had a bear put spread. We expected SDXY to go down, and we had 40 short positions as a bear put spread, and then we took but we sold 6 short puts against them, and those 6 short puts completely wiped out our profits. It was horrifying. I mean, it went to freaking zero.
So going forward, I'm going to take away from that guy. Going forward, that won't be your bag anymore. You're not going to be. Are you? There are other volatility, ETFs out there. Is that just?
No, there are.
Well, there is. Okay, so we're staying away.
We're not. That's it. I'm disgusted.
So you're done. You're done. Okay.
You got to realize though, the volatility indexes don't do what people think they do, because they don't tell you the volatility, because if the market goes up, the volatility goes down. If the market goes down, the volatility goes up. So it's only measuring negative volatility. It's not measuring volatility. It's only measuring the negative volatility in the market. It's measuring how bearish people are today. That's pretty much all that indicator tells you.
Right. Okay.
And so it's not very useful. And frankly, the reason we were playing SDXY is we had been just shorting it for a while, and we got sick of it. And then we started realizing last year that it was better to sell short puts against it every month and against our long put position. And that worked so well that we kept doing it this year. And unfortunately, we finally got burned. But it wiped out all the profits we would have made on that position. It really pissed me off. That meant there was no hedge. It meant that the market went down and one of our hedges didn't work and negated itself. And that's awful.
Right. But the reason I kind of bring that up is the use of these types of funds and even broadly speaking, leverage ETFs as a whole, people use them without knowing how to use them. There is a use if you know what they're for. You seem like, you mentioned a few of the leverage ETFs, the FAZ, that you use as part of a broader hedging strategy, or you use as a hedge as part of a broader strategy. You understand how to use them, though. There's a difference between people who do and people who don't know how to use them. And so people like Dennis, for example, just hate them. But there is a reason that they exist. There is a use for them if you know how. So where do you stand by and large? I mean, you use leverage ETFs. So by and large, you like them, at least for your strategy.
Well, I'll tell you why I love a leverage ETF, because we were just talking about this yesterday. The SQQQ is at 1750 at the moment. And you can pick up the January 2020. you can pick up the 2020 $20, $30 bull call spread on SQQQ. And it's, the 20s are $3.50 and the 30s are $4. So for 50 cents, you get $10 worth of protection. Now, it's not very useful protection because it's very far out in time and it's very high up in price. But what it does protect you against is if you have a lot of long-term retirement type positions and the only thing you're really worried about is a prolonged downturn in the market, that's what that kind of hedge is going to protect you against, because you're spending 1/20th. You're getting a 20-to-1 insurance bet. So you could take 5% or 2.5% of your portfolio and protect it against a 50% downturn in the market value of your stock for 2 years. And that's what's beautiful about it. Now, it's not going to pay you off if the market dips a little bit, but if the market drops significantly, if it goes more than 5% down, and if you're a long-term dividend type investor, you don't care if the market's up or down 5%. You care if it's down 20% and starts hurting you. And if the market goes down 20%, SQQ will go up 60%, which is $12. And so the 17s will go up to practically 30, and you'll be paid in full. And let's say you put $5,000 as a hedge, you'll get paid back $100,000 as a hedge. So that's where things like that are very, very useful. It's not the day-to-day. We're not looking to balance our portfolio to have no losses. What we're looking for is to use it as insurance against a catastrophic failure. Because anything other than that, we're going to make money on our longs. We sell calls, we sell puts, we have dividends coming in. We know for a fact, unless the market catastrophically fails, we're going to make money. But just in case it does catastrophically fail, it's nice to have a hedge.
All right, a couple more, and I'll let you go. I want to get some of the. You mentioned those. You have your watch list. Can you give us a couple of stocks on that watch list that maybe you're not long yet, but you'd love to get long if they got a little bit cheaper?
Well, first of all, our biggest one. I didn't mention this to you guys yesterday. You asked for a couple. I talked about Barrett Gold. We like, of course, and I forgot what the other one was.
You mentioned you mentioned Helios and Matheson as the one that you like.
Oh yeah, I love those guys. That's the movie cast guys.
We were just talking about it.
That is a fun one to play. Okay. Let me tell you.
Tell us why.
HMNY.
All right, tell us why you like it.
I like it because I wasn't sure about their business model. Now we've been playing them since for a couple of months now, so they're way up from where we started. But they're now just hitting $5. I forgot they we've been playing since the fall when they were $250, but they went spiking up and then they went down. So, but we still have some. What I like about these guys is I wasn't sure about their model at first, but then I realized that they're getting kickbacks from the movie companies, not the theaters. So they're buying, you subscribe to them. They buy movie tickets when you want to go to the movies. They pay for your movie ticket. But they're getting, if they buy a $10 ticket from the movie house, first of all, they're getting a discount for most of the movie theaters. So they're buying it for $6 or $8 or something like that. They're also getting a $4 kickback from the studios on a lot of these films. So they're getting money a couple of different ways. Plus, they're using your habits. They're selling your data all kinds of different ways to determine the data. And now they've just raised $100 million. They're going to invest in films. They're going to start tailoring stuff. They're going to become like a movie empire.
Have you used
MoviePass? So I really like what they're doing. They're very aggressive, and you can't argue with the growth. They've basically doubled every quarter for the last 3 quarters. Do you use it? Are you a subscriber? I'm not a subscriber just because I can't be bothered, and I have a lot of money, so it doesn't matter to me to go save like a little bit of money at the movies. But my daughters are subscribers; they don't have any money.
I'll have to say I had my first experience with it this weekend. I'm not a subscriber. My friend is, and he So I went with him, and I realized that you have to physically be at the movies in order to buy your ticket. So it was more convenient for me on a busy premiere weekend to buy my ticket online than it was for my friend who has Movie Pass, who had to physically go there and we had to wait online, and he had to get his ticket from the machine. So
it's not for that. It's not
right,
for. It's not. See, that's the thing. Like I said, I wouldn't do it. I wouldn't do it because the only time I go is on a Friday night or Saturday night when it's busy, and I want to damn well know I have a ticket.
Right.
My kids, on the other hand, are at the mall, a couple of days a week with their friends, and they love to have the fact that they can just walk into a cheap movie and go see something.
Yep.
There's 20 movies playing. They can always see something. It might not be the first thing they chose, but they don't care. They're just hanging out with their friends and going to the movies.
Yep, I get it.
It's kind of like how you never buy a discount airline ticket because you don't like the discount airlines, and you don't do Priceline even though it's really cheap, but you're not going to sit there and be randomly placed in a hotel. But there's a whole, there's a half the population on the planet is perfectly fine with that arrangement.
Yep. One way or the other, very controversial stock to be sure. Phil Davis, his site is philstockworld.com. Phil, thanks so much for the time today. Have a good weekend.
All right, good talking to you. Have a nice weekend.
All right. Phil, getting some love there in the chat. If you ever have any feedback on our guests, if you love them, if you hate them, if you want to get to know them, you can shoot me a private message, or you can just email premarket@benzinga.com and just tell us what you thought of that day's guest. I'm on that email. Joel's on that email. Dennis is on that email. And we love your feedback. So just tell us who you like and who you don't like, and we'll use that to inform, who we get on the show. Brent, I want to bring you back on here. We got a couple more minutes. Man. The one thing we didn't cover off the top that I would have liked to was Buffalo Blue. Blue Buffalo. The ticker is Buff. The ticker is Buff. The company name is Blue Buffalo.
Yep.
Earnings this morning. Earnings not relevant though.
Forget those earnings.
Forget the earnings. They're getting taken out by General Mills for $40 a share. That's an $8 billion deal. GIS taking out Buff.
Yep. How much is Buff trading up? It's trading up about 17. Let me see. Pull up my chart. 17. It's trading up at 39.83. It's up about 17%. For stuff like this, what I like to do is look to a peer, look to a sympathy play. There is a little list that I put together for some of our Benzinga Pro users. It's called Stocks to Watch. And on this list today, I don't want to necessarily point people to Blue Buffalo. That trade is more or less over, right, Spence?
It's done.
It's trading at 39.83. The price is $40. There's not going to be a ton of volatility. So when you get stuff like this, kind of try to avoid your knee-jerk reaction to go look at the surface level and look at a peer. For a space like dog food, animal food, it's a very small space, so you don't have a ton of peers to look at. So the one that I spotted from this morning was Freshpet, FRPT. Now, we can say how closely are their businesses, et cetera, but I don't think we need to do all of that kind of research and consideration. Consider that there's a small space. There's only two or three or four players in the space. One of the stocks is going to be trading up, about 20% or so. There's going to be some upward pressure likely on shares of Freshpet because of something like this. Does that all make sense?
That makes sense. Not seeing that yet this morning, though. But
nope, it's actually no. Yeah, good to mention. There's no. Right. I don't see any price action.
No trades. No trades that I've seen.
Nope. No, nothing
but
yet.
Nonetheless, still early, still pre-market. Not even 9 o'clock yet. We'll wait and see. Was there anything else? You know what? We didn't do ratings today. Let's run through a couple of ratings. Sure. We like to run through at the end of the show the ones that jumped out. Ones that jumped out to me today: FedEx getting an upgrade this morning at Bernstein to outperform. That is first upgrade I've seen on FedEx. Actually, I take that back. They got upgraded a month ago at UBS. The street analysts, at least, pretty bullish on FedEx. What else did I see? I saw Lennar catching an upgrade to outperform at Evercore. What else did I see? As far as upgrades go, those are the kind of the two that jumped out to me. And then downgrades, we had UPS. So FedEx with the upgrade at Bernstein, UPS with the downgrade at Deutsche to a hold. And those were kind of the – yeah, what else did you say?
I was thinking Spinners asked me if there's any. Ooh, Zoetis. That's actually one I was trying to remember earlier. Spinners asked me, is there any other names in the pet space I like? It's just such a small space. I think you picked out one there, Zoetis. That's not bad, Spinner. I was sort of zoned out while you were going over some of those ratings because there's some discussion on Helios and Matheson in the chat, and like I was sort of thinking about that kind of intently. I am not defending Helios and Matheson here.
Okay.
Let me just say that.
Okay.
But we got a couple chatters who are saying, the stock's a dog. Look at what they did to shareholders when they did this offering. I would just say, I think that the street doesn't fully understand Helios and Matheson yet.
One way or the other.
I think if you're an investor or trader and you're looking at this thing and you're looking at what they did, I would encourage you to consider the story away from MoviePass. MoviePass is definitely the crux, the core of what Helios and Matheson is doing, but they're doing a lot of stuff with data. The CEO has said this is a data play. They're taking marketing efforts to not Wall Street, I was going to say Hollywood. Hollywood has never really had a strong understanding of what their audience is like for certain movies. Helios and Matheson and MoviePass, they're trying to help studios understand the markets and the demographics that a lot of their movies will fit well in. And so they're really sort of like trying to apply this marketing, this data analytics thing to a space that has never had it. And that doesn't really have anything to do with, you were talking about a MoviePass experience with Phil and your friend and everything. But like it is a lot more than that. I would just encourage you to at least not discount this one. And if you are getting some trading action, spend a little bit more time researching it. It is sort of like, I would say, a pretty dynamic story that's happening.
I love analogies. I'll make one quick analogy before we go. It's almost sort of what the internet did in a sense to print media. Is the print media never really had an understanding of who was consuming their, mostly print and the newspapers and magazines never really had an understanding of who was consuming the product, right? You could see how many people are buying it, but you couldn't really understand of who was reading what specifically. There was no way to do. The internet threw that out the window. You can clearly see who is what, the demographics of who's reading, your content. And like kind of the same thing here.
How advantageous is that for the publication?
It's huge.
It's everything.
Right.
They know where to go. They know where they're going to get traction. They know where they're not going to get traction.
As far as I know, this is the first time that Hollywood has had a way like this to really understand
at least
the demographics of besides the quantity.
At least that is what I've heard from the CEO.
All right. So I think either way, it's a controversial issue. I'm definitely not bullish just because stocks like this freak me out.
Yep. Fair enough. You should be feeling that way, Spencer.
For sure. But anyway, Brent Slava
it's over already, Spence?
It's over already.
Man.
I know.
It was fun.
You did great today, Brent.
Thanks,
head of our news desk. Thanks for hopping in with
Always
me
a pleasure.
to fill in for Joel and Dennis. That is our show today, folks. If you want to catch our podcast, go to iTunes, SoundCloud, and Stitcher, or just go to youtube.com. Thanks for joining us. Thanks to Ryan and Phil, our guests today. Hope you have a good weekend, and I hope you join us again on